It really does come down to, do I believe in the entrepreneur and his ability to execute the opportunity in the marketplace?
Good evening, everyone. Welcome to Entrepreneurship 101. My name is Marielle Voxep and I manage the educational series here at Mars. We're moving forward now in our money module, our last module of the Entrepreneurship 101 series. To speak tonight on terms of investment, I'd like to welcome Shirley Speakman. Shirley is a veteran of the Entrepreneurship 101 program. She's given this lecture several times and she really knows what she's talking about. She works upstairs with the Investment Accelerator Fund. She is an investment director with the IAF. The IAF is a $30 million venture capital fund established by the Ontario government to invest in seed and early stage technology-oriented companies based in Ontario. As investment director, Shirley is responsible for investment recommendations and decisions, portfolio management, sourcing, and partnering. Prior to joining OCE, Shirley spent over 12 years acting as an advisor to companies in areas such as strategy, finance, negotiations, and fundraising. She's been involved in numerous transactions, financing, and mergers and acquisitions transactions from both the company and investor perspective. She holds an MBA from Wilfrid Laurier University and a Bachelor of Economics from the University of Waterloo. Please welcome Shirley tonight.
So first, let me say thank you very much for the kind introduction. I really do appreciate it, and I'm always so pleased to come and provide this lecture because, frankly, it makes my job much easier downstream when all of you understand what I'm looking for. So let's get started. I entitled this presentation, What Do VCs Want? And at the end of the day, I think it's really important that you understand that what we want isn't that much different from what you guys want. You all are coming to us looking for money. The difference between us is that you're looking for money, I'm looking for big money. And what I mean by that is because I'm a VC, this motivation is driven by, frankly, my model. And that model impacts the terms and conditions that I look for when I make an investment. And I'm going to tell you a little secret that you might not want to hear, but it's important for you to understand. Most companies aren't VCable because you don't fit the model that I demand as a venture capitalist. That doesn't mean that you don't have a great company. That doesn't mean that you can't, double your revenue every year. Imagine that, doubling your revenue every year and not being a good VC opportunity. But if you do happen to be a company that fits the VC model, which I hope I can explain to you tonight, then I'm also hoping that you'll be better equipped to understand where I come from so that we can get to a deal faster, or from where my colleagues and I come from. So let me start by saying it's all about the frogs, from my perspective. I have to meet a lot of companies in order to find my prince. In fact, I have to meet about 1,000 companies to generate the 10 investments that generally a venture capital fund will invest in. And of those 10, 2 companies, more often than not one, is wildly successful. And it's that 1 or 2 company that make the returns for a venture capital fund. The other 6 are kind of languishing in the land of the living dead, is what we call it. And that means that it's not a company that we want to pull the plug on, but it's not really, we know that it's not going to be a big win for us. And then there's 2 that flame out and fail horribly. So as you can see by the math, my winners have to offset my losers. So generally, if you're looking at a startup company, I will look for a company that can give me a 10 to 12 times return on my money in a 5 to 7 year time horizon. So if I invest $500,000, I'm looking for a $5 million return in that amount of time. So you understand now what I mean by I'm looking for big money opportunities. If, however, I'm taking a look at a later stage opportunity, then I'll reduce that expectation from 10 to 12 to 5 to 7 because the time horizon is a bit different. So now those are all just general rules of thumb, but what I hope it shows to you is how the venture capital model works and why that model drives certain behavior within a venture capitalist. So what does that mean for you? As I said earlier, that means that a company that doubles every year isn't good enough. That every opportunity, all of those 10 companies that I eventually invest in, I have to believe all of those have the capacity to be that home run. And if I don't believe that it has the capacity to be that home run with those metrics and parameters, I shouldn't be making the investment. So let's take a look at one great example everybody loves to talk about. It's YouTube and Sequoia. Sequoia is one of the granddaddies of the venture capital business. And that title is rightly earned. They've done it for many years, and they've been very successful. They are one of the top quartile funds. There's only about a handful of funds, venture capital funds, that actually make money and have done it consistently. Sequoia is in fact one of them. So the deal stats, as we call them. So YouTube sold to Google for $1.65 billion. Sequoia invested $11.5 million in 2 tranches into YouTube, $3.5 million in 2005, and then another $8 million later that year or early in 2006. By the time they exited, they owned 30% of the company, which gave them a whopping 43 times return. So the neat part of that is that they were the only venture capitalist in that deal. In my mind, that was a great deal. That's the big money deal. So to set your expectations correctly, that is not how it typically works. That was a venture capitalist who was very familiar with those entrepreneurs and was very knowledgeable in his field. It generally takes 6 to 9 months to raise capital. And frankly, it will take several meetings. And if you think about it, that makes a whole lot of sense. The venture capitalist has been given money by other investors to invest in companies. And if all the venture capitalist is going to do is take one meeting and decide yes or no that they're going to invest in you, they're really just gambling. They have no sense of your track record. They have no sense of how well you operate. I have a metric that I call my say-do factor. I want you to tell me what you're going to do, and then I want to see you do it. And I want that metric to be really close to the truth, because that really builds confidence. So as an example, at the IAF, we start taking a look at companies very early. There's companies that I've looked at for probably about 1.5 to 2 years. And it just takes the entrepreneur time to build up that confidence, for him to be able to come back and say, look, Shirley, 6 months ago, I told you I was going to accomplish this. I've accomplished that. Or this is the reason that I haven't accomplished that. But it's that familiarity and that comfort with you that I need to build up over time. But frankly, that's something that you should be doing with me as well, because this is going to be a marriage for a long time. 5 to 7 years is a long time to have a venture capitalist sitting on your board or asking you for financial reports or asking you why you were able to achieve certain things or not. So I really strongly recommend that you use this as a process as well. Get to know that venture capitalist. Know who's making the decisions at the firm. Are you meeting with an analyst, or are you meeting with the partners who actually are making the investment decision? What's their fund cycle? Are you talking to them early in that fund, or are you talking to them later in that fund? Because if you're a startup and they're 2 years from closing their fund, there's a mismatch, and you're both wasting time, because you're never going to fit what they need at this moment in time. Find out what their last deal was. If their last deal was in clean tech and you're a healthcare company, probably not a good match. Talk to their existing CEOs. They're going to try to find out about you as much as they possibly can. You should do exactly the same thing. What do they like to deal with? And one of the most important questions you can ask and try to figure out is, what do they like in bad times? Are they good investors to have in bad times? Because as you probably know, building a company is a roller coaster. There will be good times and there will be bad times. And the strength of a real investor is, do they stand by you during those bad times? Find out how much cash they have available and find out what their policy on reserves are. They might have a huge fund, but do they hold back money to put into their winners? You certainly don't want a venture capitalist who's going to make a one-off investment with you, because you're inevitably going to go out and raise more money, and it's a whole lot easier if you can say, yeah, my existing investor is willing to participate in this round. It just sends a clear message to the market that your investors are confident in you. The other thing I would suggest is that venture capitalists will rarely tell you an absolute no. I wish more of them would. I do have a tendency to do that. But nobody wants to be the guy that turned down YouTube. So just make sure you're not wasting your time as well. So if you don't get to a yes, then it's probably no, we're not interested for some reason. And again, I'll just reiterate, make sure you get to know them well enough that you can feel comfortable having them with you for the long run. So assuming that you can find yourself a venture capitalist, and assuming that you can both agree that you want to spend a lot of time together, then you might be issued a term sheet. So let's talk about what the term sheet is, because I think that's part of what tonight is about. It is a non-binding offer to invest. It only sets out the general terms that we'll make the investment in, which, by the way, can change based on how these negotiations go. And to be honest, I have never been in a deal where a term sheet hasn't been used, in part because it's just a great place to start and to lay out the way we're going to go forward. So let's talk about some of the basic terms of a term sheet. There are some pretty simple, non-heartache terms. They're pretty simple. They're the company name, the investors, how much the investors are willing to invest, and the date. So those are terms that I have found people are pretty okay with. They don't really want to negotiate those. Everything else becomes difficult. And the big one is, of course, valuation. What you believe your company is worth is very different than what a venture capitalist believes your company is worth. And this isn't fair. It's not right, but it's just the way it is. There is no pure science to this. It is an art, and at the end of the day, it's what a willing buyer and a willing seller are willing to settle on. So people often come to me and they say, well, let's use a discounted cash flow because that's tangible. We can use math to figure that out. And I'll say, what cash flow? They'll say, well, this company sold for a multiple of revenue. And I'll say, well, what revenue do you have? And they'll say, but there's a company down in the valley that got an investment at this valuation. And I'll say, well, who on your management team was with that company? And so you can't make direct comparisons. And that's why I say this is an art. And at the end of the day, it just has to be something that you can all live with and not feel like you've given up too much of the farm. Maybe that's a good way of describing it. But I'll be frank, it does start somewhere. It'll start at revenues. We're going to want to see your revenues. What are you projecting? And this is where that infamous hockey stick projection comes into place. I'll tell you, I never believe those. I always see them, and I never believe them. My first reaction is to rationalize those and tell you that it will generally take twice as long and twice as much money to get to where you think you can get with one round of financing. And after 60 plus companies, I have never, ever, ever seen a company meet the projections that they said that they provided me when we made the investment. So we start with the rationalized forecast then. And what I hope over time is that as you go out and raise more money, your post-money valuation increases. And even because you're still in the private market, that post-money valuation is still not a real valuation. It's just what those investors and the company could agree upon at that point in time. Where it becomes a little bit more tangible is when you start having revenue. And you can start saying, yeah, you know what? Generally, companies in this industry should be getting, for example, a 3 times multiple on their revenue. And if you take a look at that, that means for that seed investor, they will have perpetually overpaid for their initial investment until the blue line crosses the green line. So that's where you can see an early stage investor will say, you know, you might believe your company is worth X. I know it's worth something else. So it's that gap that you're just trying to address and to mitigate. So assuming you can find yourself a VC, assuming you can get yourself a term sheet, assuming you can agree on the non-heartache terms and you can get yourself over the big heartache term of valuation, what are some of the other things that a VC is going to want to see as part of their deal? Frankly, at an early stage, a lot of it comes down to intellectual property. If a company is a robust technology company, I'm going to want to make sure that the founders have assigned any intellectual property rights that they might have to the company. I'm going to want to make sure key employees have done the same thing. Any consultant that you might have hired over the past who may have or may not have contributed to the intellectual property of the company, I'm going to want to make sure their agreements have contained that intellectual property assignment clause. Many of you are using students in labs. Make sure that any contract research projects that you enter into have clearly defined IP clauses within them. And my biggest suggestion is to really avoid convoluted intellectual property structures for tax purposes. I had one entrepreneur come to me, and frankly, and he had IP sequestered in Bermuda, and there was this over here, and I just thought that just gave me a reason to say no. And your goal, if you're out trying to raise money, is never give somebody a reason to say no. Because you might be sitting down with me, but I can tell you, my day is booked with people who are presenting me with investment opportunities, and the last thing you want to do is give me a reason to say no. So let's talk a little bit about those key employee agreements. You always have to have a non-competition. You always have to have the non-solicitation, which, I mean, non-competition is pretty obvious. Non-solicitation is that if you leave, you won't try to poach employees or customers from the company that you're leaving. And of course, that IP assignment clause. Next is the ESOP. So you've started a company, you're starting to hire employees, maybe some co-op students, and you need to attract that talent. I think everybody is in agreement, whether they're venture capitalists or entrepreneurs, that a good way to make sure that everybody is rowing the boat in the same direction is with an ESOP. Now there's some rules of thumb on an ESOP. I've generally seen 15 to 20%. I've recently seen ones that are as low as 10 to 12%. But just so that you have a benchmark. Oh, I am terribly sorry. Employee stock option plan. So the employee stock option plan is just an option for the employee to buy shares in a company at a later point in time. And so that just motivates everybody to try to increase the value of the company. So as low as 10 to 12 and as high as 15 to 20% of the share capital of the company. So if you have 100 shares outstanding, 10 of those would go to the ESOP to be allocated among employees. Make sure that whatever number you settle on, you're comfortable with, because that will have to pay for probably a new CEO, definitely new executives at a sales level or a VP tech or CFO. You're going to need to have an ESOP or an option plan that will be available for board of directors members, because that's how you'll end up compensating them for the time and mentorship that they provide. I would suggest to you that venture capitalists should not have access to your ESOP pool or your option plan. This is their job, and they get compensated differently. They get compensated from their fund to do their job. The trick for you when you're looking at a term sheet and looking at an ESOP plan is try to figure out whether the venture capitalist is asking for you to put the ESOP plan in before he puts his money in or after he puts his money in. Because whether it's before or after directly impacts how dilutive it is to you, okay? And frankly, every venture capital deal I have seen has been a preferred share structure. A lot of people don't like preferred shares. There's two types of equity in a company. There's a common share, which says everybody's exactly the same. And if the company and everybody rides success the same way and everybody rides failure the same way. A preferred share says, I am equity, but I rank ahead of the common shareholders. So that if a company goes bankrupt, then, and there's a little bit of money left over, we've paid off all the people that we owe money to, whether that's the bank or accounts payable, then any money left over would first go to the preferred share, and then after that, it would get distributed to the common shareholders. So the rationale for this is pretty simple. The venture capitalist feels that you, as the founder, are responsible for the day-to-day operations of the company. And if anybody is going to bear the biggest brunt of a failure, it should be the entrepreneur as opposed to the investor. Although by taking equity, they're willing to participate in some of that risk reward, okay? Every preferred share that I've seen has had some form of a dividend attached to that. And generally, these aren't paid out like a public company where you get your dividend annually. They accrue. And if a preferred share ends up having to be converted because there's another round of financing that forces the conversion, or there's an IPO, then it is the price that the investor paid for that preferred share plus the dividend that they have accrued that would convert, not just the share. So it's rarely a one-to-one conversion if it ever happens. And it's material because the dividend, you see the small pile of money? The dividend will impact that conversion amount over time. The longer it's outstanding, the bigger that pile of money for conversion at the end of the day is. The next one is the liquidation preference. And generally, all of these terms I'm talking to you about matter in bad times, not in good times, right? The liquidation preference basically says, if we end up getting a chunk of money, the venture capitalist gets an amount of money out first, and then whatever's left over can get paid out one of two ways. The preferred share gets converted into common and then divvied all up among everybody. So if you think about it, that gives the venture capitalist a double dip. They're getting their preference, their liquidation preference back, and then they convert that big pile of money that we talked about earlier into common shares. And then they participate again in the divvying up of whatever is left over, or whatever is available on a liquidation via an acquisition of the company. So you just want to make sure whether that's whether there is a liquidation preference at all, and two, whether that is a one-times liquidation preference, so they get 1 times their money back, whether it's a 2 times liquidation preference, so they get 2 times their money back before you get paid out, or I've been in this game long enough that back during the internet bubble, it was a 12 times liquidation preference. But that's because valuations were so high. So that's another topic. So that's the impact of a liquidation preference. And it's very important for you to understand what you're buying into, or what the venture capitalist is buying into, and how that impacts you. And as a result, what you're willing to accept from a valuation perspective. So there's often a negotiation between valuation and some of these terms and conditions. And I often, when I was doing advising, I'd often focus the entrepreneur not so much on valuation, because it is going to be what it's going to be, and you'll eventually settle on something. But if you're going to negotiate something, negotiate these terms and conditions, things like liquidation preference, things like dividends, because they impact you downstream in very meaningful ways. The anti-dilution protection is another clause you should be taking a look at. And basically, again, it comes down to protecting the VC's downside. What happens in bad times? So let's go back to that financing strategy chart way earlier where we talked about doing a seed round and then an A round. And you notice I was being very generous. The seed round came in, and then the A round came in, and then the B round came in, and then the C round came in. Well, I got to tell you, that's not typically what happens. The C round comes in, and then maybe an A comes in, and then there's a B. And so the valuation of that B round has gone down. So if there's an anti-dilution protection in your term sheet with your venture capitalist, that means it gives that venture capitalist the opportunity to protect their investment. So if the venture capitalist had invested at $1 per share, and then you have to do what's called a down round, because you're out raising money, but nobody's willing to come to terms with you on valuation. And the only valuation you can get is something low. And you end up raising money at 50 cents a share. Then there's one of two ways a venture capitalist will treat that. They will treat that as, okay, full ratchet anti-dilution protection. You have to issue to me the number of shares that make me whole. So as if I had bought that original investment at 50 cents a share. Another way of looking at it, which is far more prevalent, is a weighted average. So what they do is they say, okay, X number of shares was bought at $1 a share, X number of shares were bought at 50 cents a share. What's the blended share price? And then you issue the venture capitalist the number of shares to bring his average share price down to that level. But this is one of those terms that you really should understand and make sure you understand the implications of for yourself and your company. Redemption. A venture capitalist is a venture capital fund. A venture capital fund has a fixed life. They generally don't go on forever. So they're going to want to have an ability to get out of the company. And this is typically accomplished via a redemption. So there's a couple of ways you can do that. You can have a put clause, which basically says, I'm going to sell you, I want the company to buy back the shares that I purchased at fair market value, or it gives them the ability to force a sale of the company. So let's go back to that timeline. This becomes very important to understand how long a venture capitalist has left in the life of their fund. If you're a startup and you need 5 to 7 years or longer in order to create value, you definitely do not want to be talking to a venture capitalist who only has 2 years left on their fund, because you know what they're going to do with this redemption clause. Other rights and privileges. There are many things that can fall into this bucket. And what really matters is that over time, you get to know that VC that you're inviting into your club, so that you get to know how they're going to react in those good times and in bad times. And what you want to know is how they're going to behave. So let's talk about some of the things that this bucket of terms and conditions can do for you. They generally can't tell you what to do, but they can certainly prevent you from doing certain things. So, for example, approvals. We're going to need between 60 and 66% of the shares outstanding to change the nature of the business. So I, as a venture capitalist, have invested in a clean tech company. If somebody is now going to go out and say, I don't want to be a clean tech company anymore, I want to be a SaaS-based CRM company, I want to be able to say, that's not what I invested in. I want to know if there's going to be a change in the capital structure of the company. So you've decided to go out and raise some money. That's generally a good thing. It also generally requires that the articles of incorporation be changed to provide for the creation of new classes of shares that the new investors are going to want. I want to have approval over your business plan. I want to know that the people that I have invested in are actually in the company. And if that's going to change, I want to know. The creation of the ESOP we talked about earlier. Any unbudgeted expenditures. The IAF generally sets those unbudgeted expenditures at about $5,000. So if you give me a budget that I've already approved, you can always come back to me and say, Shirley, there's something that came up. There's a new trade show that I want to go to. And that's outside the budget that we agreed to. And it's going to be more than $5,000. So I need your approval. And then any arm's length transactions. Frankly, I'm not really keen on companies and entrepreneurs that hire their brother-in-law and sister-in-law and sons and daughters. I want to hire the best employee possible. And so I always require approval over non-arm length.
You had full PM up there on the previous slide. I didn't get to ask what it was.
Other people's money.
Okay. Got it.
Information rights. These are requirements of any venture capitalist. We have investors that we have to report to. My investor happens to be the Ministry of Economic Development and Innovation. That's where the IAF's money does come from. And I'm going to ask you for financial reports on a monthly basis, generally 20 to 30 days from month end. And if you think about it, if you're managing your business, you're going to want that information anyway. I'm going to want to see quarterly financials, which will allow me to say, this is what we said we were going to do, and this is what we did do. And then I'm going to want an explanation if there's a big variance, which again is just good business practice. And it also helps me manage the investment. I'm going to want board materials, and I'm going to want those more than the day before, please. I do like to be a value-added board member. And I generally need to have more time than a day to read board material. And of course, a yearly operating plan so that I know where we're going and what we're doing. Again, all just, if you think about it, just all good business practice. Share restrictions. These tend to be a little bit more upsetting for founders because they restrict what you can do. A founder is what I have invested in. And if you want to sell your shares in the company, frankly, that's signaling something to me. What would it say to you if, I decided I wanted to sell my shares? So you have shares in the company, you've decided that you wanted to sell them. There's typically restrictions around what you can sell, when you can sell it, who you can sell it to. And I think from the venture capitalist perspective, that's reasonable. I have invested in you. I want you to be invested in this company. There's generally drag-along provisions. So if you go back to the fact that a venture capitalist has a fixed life, they have to get their money out of the investments that they've made. So if somebody comes along and says, I want to buy the company, the venture capitalist, and it's a reasonable price, the venture capitalist will say yes, and by the way, we can drag people to make that happen. So you will have to agree to vote your shares in favor of the sale of the company. There's tag-along rights. Sometimes we get into situations where people want to sell a portion of their shares. And again, this represents an opportunity for the venture capitalist to exit their investment. And they are always focused on getting an exit out of their investment. So if somebody puts up their hand and says, I've had somebody come to me and they want to buy 100 shares, as a venture capitalist, I can come along and say, well, I want to sell part of my shares in that transaction. The board. This is another area where a venture capitalist is going to want to have some say. Typically right now, you all have, if you have a board, it's dominated by friends and family. Please accept the reality that when you ask for other people's money, that's going to change. They're going to want to have other people at the table. They're going to want to have experienced board members, people who have been there and done that. who can maybe open doors that you might not be able to open for yourself. The best thing a board member can bring is a Rolodex. Your challenge as a startup is getting sales. So always look for investors who recommend board members who can help you do that. The general structure is 5, I would say. It's reasonable because that's nimble enough and to get to approvals and votes. You get too many people at that table and there's too many voices and things get difficult to organize and you're not optimizing the outcome of and the productivity of a board if it gets too big. And as I mentioned earlier, I do expect material in advance. And generally, there is a rule that if the board meeting has to be postponed because the venture capitalist isn't there, which is generally a venture capitalist will insist on a board meeting being there, a board meeting occurring only if their nominee is present. If it happens that the venture capitalist nominee cannot attend the board meeting, they get 1 deferral. If that person decides that they can't show up at the next board meeting, that's too bad. We're not gonna prevent the company from doing their business because you can't find it in your time and in your schedule to get to the board meeting. Next is the fact that a term sheet is non-binding. I started out earlier saying this is the non-binding terms and conditions that we're outlining. And that is 100% accurate except for a couple of things. It's not true for the deadline. There's generally a deadline to accept a term sheet. And if you're not going to accept a term sheet, tell the venture capitalist that. It helps with that reputation, your credibility. It also helps with it's just etiquette. You just want to make sure you do that. And there's a no shop clause in it, which says that once you accept this term sheet, you shall not go out and try to solicit any other investment. So once you have signed back that term sheet, you've agreed. We're going forward. Because the venture capitalist and you then have to invest a whole lot of time in trying to get to a deal and getting the documents done. And neither of you want to waste time. And the big thing during this whole negotiation of the term sheet, trying to get to the final documents, is to be very careful what you ask for, because you do not want to send the wrong message. And I'll close with just one thing, the golden rule. Frankly, the golden rule is he with gold makes the rule. So there you go. And I'm happy to take questions.
I had a question about can you hear me?
Yep.
A couple of your slides at the beginning. I think you said that if you're doubling your revenue every year, you probably wouldn't be interested. But then in another slide, I think you said if you 10x your revenue in 5 to 7 years,
right. So,
you would be interested.
Right.
But if you double every year, it's actually more than 10x in 5 to 7 years.
So what I want to see as a venture capitalist is that breakout. So 500 to $1 million, okay. 500 to 3 million is the trajectory that I'm looking for. So what I'm looking for is the trajectory that will get me that 10 to 12x return. If I can get that 10 to 12x return earlier, I'm even happier, right? So the math is a little bit off.
So it's not doubling every year, it's just doubling in 5 to 7 years.
Well, it's just get me 10 to 12x in the investment horizon that I'm looking for is kind of, and more importantly, what I'm truly looking for are companies that are on an accelerated growth trajectory. So, a 10% growth rate, not going to interest me. So it's just show me that breakout, that you have a big market and you know how to attack that market. If you talk to the US guys, they often say, if you can't be a $200 million company, why are you even bothering? Right? $200 million revenue company. Mm-hmm. Not value, $200 million revenue, which means that your value is so much more substantial. Okay? Does that help?
Yep. Thanks.
Hi, Shirley. I have 2 questions. The first one is regarding when's the right time to go ask for money? And the second is regarding your point about making sure that employees are motivated, but at the same time, make sure that you're protecting the IP. I'll go into them, each one. The first question is about when is the right time to get VC money or any external investors' money?
So could I answer that question for you? Because I think it's a very important one.
Yeah.
Never.
Yeah, because
Like,
Charles
frankly-
Pran said, bootstrap.
Really, when somebody comes to me and says, I'd like you to invest in my company, my first question is why? If it is such a great opportunity, why do you want to give any of it up? And so your case for telling me why you want investment has to be very strong. It has to be very convincing. And frankly, if I'm going to come in with all of these terms and conditions, why would you want somebody else's money? You want somebody else's money because you think you can grow faster and capitalize on an opportunity that you cannot achieve otherwise. So you can't hire that CTO you need without capital. You can't open up an office in New York without that capital. But make sure that you have very strong reasons for asking for the money. Because otherwise, you're probably better off just growing the business with customers. The best financing you can get is from customers.
So now going into the second question, regarding IP assignment as well as ESOP. So your point is to make sure that we incentivize and motivate employees and other contributors so that they will be dedicated to the business, to the venture, but at the same time, make sure that they won't walk away with the IP.
Right.
Okay, at the very early startup stage, a lot of time, like in my case, I would be using informal advisors. So I don't know how I can make them, okay, Mr. and Mrs. or Mr. So-and-so, I would love you to advise me, but I want you to first of all sign my IP assignment before we even talk. By the way, I'm going to add you into my ESOP that I am about to create.
Yeah, so by IP, I mean intellectual property, things that are patent or patentable. So where that really comes into play is if you're hiring a consultant to help you write code or to do experiments on your science. Those are core things that I want to make sure are very tangibly tied up.
How about using students through the MyTalks program, the government grants program, or those ARC programs? It seems to me that university have certain courses that they want to share your results. So what are we going to do?
So I'm not 100% familiar with the MyTax program, but I would suggest that anytime you deal with any university program or government program, you understand what the IP provisions are. Okay. Some universities are inventor-owned, some universities are university-owned. Some universities are you can negotiate that if you've paid for the research, you get it. So just regardless of what it is, make sure you know what it is so that you can put the right strategy. Is it appropriate for you? That would be the question. Okay.
If anyone watches Dragon's Den, the big thing that they always seem to dwell on is valuation.
Yeah.
And if entrepreneurs are not born, but they can be created, and valuation is an art as opposed to a science, what's one of the first two lessons an entrepreneur can get for themselves to really learn how to paint that valuation in such a way that it looks more like a real picture as opposed to a stick figure?
The big thing I'll go back to is developing the relationship with the people that you expect to raise money from. That's the biggest thing you can do. Make sure that when I'll go back to that say-do factor. You know, I will take a coffee with just about anybody, and I just about anybody. And I would love to hear your story. And then in 3 months, come back to me and say, this is what, just build up that credibility, because if you go back to that little line, the green line versus the blue line, I know I'm overpaying. Just make me feel good about overpaying. And that's familiarity and building my confidence that when you say you're going to do something, you do it. Because that means that I can have confidence that when I make an investment in you and you've got a plan, that plan has a higher probability of coming to fruition, as you say. So you reduce my risk.
And the flip side being that if you don't establish that relationship and you don't build that confidence, that's probably the biggest negative people have in terms of determining valuation.
Yeah, when people come in and say, give me money. Who are you? Why would I give you money? How? And I don't give money, I invest money. That's the other thing to make sure you appreciate. There are many worthy entrepreneurs out there, and I don't have trouble finding them.
I want to congratulate you on the speech. It was one of the most beautifully timed speeches I've ever heard, so very good. I'm a little bit confused about the connection between the IAF grant and
not a
applications
grant.
to that grant, and what you
Yeah.
said generally. Do the same things that you were talking about pertain to the IAF grant?
So,
And
yeah.
specifically, it was my understanding that it was actually a group of investors who put up money for that grant, but you mentioned a ministry, and I didn't get which
Sure.
ministry.
So the first thing to be very clear on is that we are not a grant. We actually are investors. And we will invest like you would see any other investor. I think what you might be getting confused with respect to the other fund is that Mars does have a Mars Clean Tech Fund, which is a private sector fund in which individuals have invested.
So who is on the committee? I can't
So
remember
the-
whether
sure.
you said you
So the-
chaired or not. Who?
Sure. So the Mars Investment Accelerator Fund is a $30 million investment vehicle that the Ministry of Economic Development and Innovation created back in 2007. We've been investing since 2008. We have investment professionals in Ottawa, Waterloo, and here in Toronto. Our investment process is very rigorous. We have both an internal panel that helps us make our investment decisions and an external panel that helps us. And that external panel is made up of venture capitalists from the Toronto area, as well as private angel investors. And on the clean tech side, if there's a clean tech investment, we have people from funds from Montreal that participate as well. The due diligence process is very rigorous. If we go in all by ourselves, we use an instrument called a secured convertible debenture. The secured convertible debenture is essentially a loan that is provided to the company. It is secured against the tangible assets, and you all have tons of those, right? The tangible assets and intellectual property of the company, which leaves accounts receivable and shreds available for financing. If there is a financing before the end of the 3-year term of the loan, then we convert our secured convertible debenture into whatever security is being made during that financing. So we would convert our $500,000 investment, as an example, into the preferred shares that venture capitalist is providing the company as their investment. So what we really do rely on is the market to set the price. So in that way, the IAF is different than venture capital funds. We use a lot of the same rigor and methodologies in evaluating the investment opportunity, but our plain vanilla instrument does not set price or valuation. We rely on the market to set that for us.
And is there, you have several areas, social innovation, communications, and then the more technical ones. Is there a bias toward any one of those? I mean, statistically, which area?
Statistically, I believe 60% of our portfolio is in what I would call the ICE, information, communications, and entertainment. 20% would be in clean tech, and then the residual would be in things like healthcare, IT, and life sciences.
Is there any published list of which companies?
You can go on our website, marsdd/IAF, and you can see the companies that we've invested in.
Thank you.
There are some sectors which are fashionable or politically correct. Some like solar energy, for example, has been economically utterly disastrous. What areas of your experience have been successful? What fields have been worth going into?
That's an interesting question, because that requires me to be a bit of a prophet too, doesn't it? I generally just look for really good business opportunities. So contrary to what the general feeling is, I have actually invested in a solar company just recently. Now, it is not a solar panel company because the market dynamics around a solar panel are very different right now. And there's some global trends that are affecting that. But talking about the microinverter or the power electronics that accompany a solar panel, if I can find a technology that's very innovative there, which I believe I have, that's interesting to me. I've also invested in a high-performance computing company. And that's not IBM. It's a spin-out of the University of Toronto. I just look for really great business ideas that I believe solve a true pain point in the marketplace.
But what, in your experience, has been successful?
I have successfully exited out of a social media company. I've successfully exited out of a leak detection company, water leak detection company. What has been successful is finding good companies and then helping them accelerate, proving their market, proving their customers, and then helping them find the right acquirer. There are people in this business who will say they will invest in nothing but water because that's a huge opportunity. I can only invest in opportunities based here in the province of Ontario because that's where my money comes from. And frankly, there is a lot of good opportunities here. And if you get the right investors in the right place at the right time, you can make some good money.
Shirley, we have a question on the webcast coming from Steve. Many early stage companies do not have a strong customer base or sales. Can you comment on the criteria for early stage and angel investing?
The founder. That's what it really comes down to. If there isn't a proven market and there isn't somebody who I can call and I can say, are you willing to take your wallet out of your back pocket and pay for this product? Then it really does come down to, do I believe in the entrepreneur and his ability to execute the opportunity in the marketplace?
So did you just imply that a founder should actually invest in the company or just potentially buy his product when it comes out?
Well, no, I meant that as a venture capitalist, one of the most important things to me is, do I believe in the founder? Which really goes back to, have you developed that relationship with me? So if there isn't a solid metric, if you don't have revenue, or I can't do customer calls to validate that there is an opportunity, then it really comes down to my belief in you, in your ability to execute on the opportunity in the marketplace that you say exists as a founder, an entrepreneur. But sure, go on Techstars and get people to buy your product before it's made.
If anyone is looking for more help on raising money, the Entrepreneur's Toolkit has sample funding documents and downloadable term sheets. So you can find those in the Funding Your Business section, and we'll put them into Monday's blog as well with the lecture video and Shirley's slides. Next week's lecture is going to feature a panel of Toronto VCs. They're going to be here to tell you their secrets on what VCs are looking for and how to successfully pitch. It'll be a Q&A format, so we'll have a moderator asking them questions, and then you'll have an opportunity to ask them questions as well. I'd like to thank Shirley for another fantastic and very informative presentation.
Thank you.
Thank you for joining us.
I enjoyed it.